Red Cat Holdings is the current darling of the defense drone sector. If you follow the press releases, you see a company dominating military tech, backed by glossy photos of NATO partnerships and lucrative armed forces contracts. But look at this downward trending line chart of the stock price. The reality on the open market is jarring. As of early August 2026, the stock is tumbling on negative news, and short interest sits at an enormous 27.17%. That means nearly 1 out of every 3 available shares is actively being bet against. The data driving that downward pressure is documenting in SEC filings, legal dockets, and quantitative models, details that sit in sharp contrast to the company's public-facing narrative. To understand the true risk of buying into this company, we have to look past the press releases and audit their internal health from the inside out. We start in the boardroom. Since early 2024, Red Cat has cycled through 4 different chief financial officers. Turning over the person responsible for the company's books 4 times in 2 years points to severe operational instability. That instability extends to the revenue side. In July 2026, the board terminated Chief Revenue Officer Jeffrey Hitchcock for cause. Hitchcock immediately fired back with an active civil lawsuit against the company, alleging retaliatory termination and breach of contract. George Mathis, the founder who built Teal Drones, the crown jewel acquisition of Red Cat's portfolio, resigned in late 2024 to launch a direct competitor, Vector Defense. Red Cat attempted to stop him by suing for trade secret theft, but in late 2025, a federal judge denied their request for a preliminary injunction, effectively letting their former top talent walk away with his expertise to fight them in the open market. This chart visualizes exactly how the people closest to the company are reacting to that chaos. Over the past year, corporate insiders have liquidated roughly $24 million in stock. At the exact same time, there has been zero volume of insider buys, not a single purchase. These sell-offs are coming from the very top of the food chain. CEO Jeff Thompson sold shares in April 2026, and independent director General Paul Edward Funk dumped over 165,000 shares in a single day, a transaction worth nearly $1.9 million. If the company's upcoming financial future is genuinely as bright as their public projections claim, you have to ask why leadership is so aggressively abandoning ship. The answer might be found on the product floor. 2 prominent short-selling firms, Carisdale Capital and Fuzzy Panda Research, recently published scathing reports accusing management of heavily exaggerating their operational reality. Take their most hyped Army contract. According to Fuzzy Panda's data, this specific military program is actually worth $12.9 million, which is 60% lower than the CEO hinted at to shareholders, and it covers 46% fewer units than expected. While Red Cat falls behind schedule, competitors are filling the void. Skydio has already successfully delivered hundreds of units to that exact same military program, with hardware actively sitting in boxes, ready to deploy. Former employees claim Red Cat is plagued by a 60% initial test failure rate on their own lines. And despite promising massive automated manufacturing facilities for years, financial filings show a complete lack of capital expenditure on the equipment actually required for mass production. These manufacturing failures suggest the company is operating as a story stock, hindered by severe production bottlenecks. Zooming out to the macro level, respected quantitative models are picking up on this disconnect and flashing severe warning signals regarding the company's financial health. This gauge chart tracks the Beneish M-Score, a mathematical model used to detect accounting fraud. The standard threshold for concern is -1.78. Red Cat's score is 15.18. By crossing the caution threshold so aggressively, the model explicitly flags the company for suspected financial manipulation. The warnings continue when we look at the Piotroski F-score, which measures operational efficiency, sitting at a dismal 3 out of 9. Meanwhile, their Sloan ratio drops deep into the negative. In plain English, these metrics indicate that whatever profits they are reporting on paper are not actually backed by real cash flow. Unsurprisingly, that kind of financial maneuvering invites lawyers. The company is now facing mounting legal exposure from multiple class action securities lawsuits, alleging they actively misled shareholders with false business information during their most critical growth phase. Quantitative manipulation warnings combined with active legal battles represent an expensive, existential threat, one that the current stock price completely ignores. All of these historical risks are about to collide in the present tense. RCAT's upcoming Q2 2026 earnings report is right around the corner, and analysts actually expect a year-over-year decline in earnings despite higher revenues. This line graph illustrates the financial miracle required to fulfill their public narrative. To hit their published targets, the company needs a $109.5 million earnings turnaround, jumping from negative $75.5 million today straight up to a positive $34 million by 2029. Because the stock is currently priced for that exact miracle to happen, there is no margin for error. A single disappointing quarterly report could cause the entire valuation to collapse overnight. RCAT Holdings is the quintessential stock. They have weaponized a military narrative to mask executive turnover, manufacturing failures, and unachievable financial projections. Caveat emptor: let the buyer beware. It is your responsibility to look past the media hype, read the fine print in the SEC filings, and always follow what the insiders are doing with their own money. If you want to continue learning how to investigate the fine print of the stock market and spot these warnings early, like, share, and subscribe.